But first, we start off with the market rally. The Dow surging to an all-time high. It's now up 8% this year. Intel and Caterpillar leading the blue chips higher. But while the market surges, the phantom of inflation is creeping in.
Ooh, that's scary,
Mel. Inflation. Amazon hiking wages, Pepsi raising prices, and this as companies are already dealing with higher input costs. Bearing the brunt of all this, retail and restaurant stocks, which got nailed today. Check out some of these moves. Macy's, Nike, Best Buy, Darden, all down today. So, two-part question here. Follow along, people. Two-part question. Is it just a retail problem, or is it a warning sign for the broader markets? Guy.
What was the first part of the question? Is it just a retail problem, or is it a broader warning sign for the market?
Very good.
See, I did pay attention. I saw Phantom of the Opera when it first came out.
I'm sure you did. Part one.
I can break into song. Is it just a retail problem? Retailers have all had a huge run. You look at Macy's, look at Nordstrom's. I mean, Nordstrom's went from 50 to 63 or so, giving some of it back. So I think in retail, at least, it's just a sort of a back and fill off an overextended move to the upside. I do think, though, think about this. If the consumer is 73% of our economy, and if the consumer starts to feel strapped in the form of higher prices, that could potentially derail the market. But I'll say this. I thought we wanted higher inflation. I thought that's what the Fed's been asking for the last 6 or 7 years. So instead of saying it was a derail the market, we should be saying this is a sign of a great economy. The market goes higher on the back.
But if you extrapolate those signs of inflation, that gives the Fed more reason to go. More impetus.
That's their mandate.
Exactly.
One of their major mandates.
And if that is our fear in the market as an investor, then you got it.
Well, you have Fed funds at 2%. You have inflation at 2%. So where are real interest rates? Still at zero, okay? I mean, that's really the issue, right? So if the Fed really gets on their horse, they're going to raise in December, and then they kind of affirm the fact that they're going to raise 3 times in December. That's the question. How does the market deal with that? So as far as the wage inflation is concerned, we also know that real wages adjusted for inflation aren't really rising, right? So if you take it back around and say if there's not more money that the consumer has to spend at retailers, but retailers' expenses are going up in the form of higher wages, then you get into a margin situation, which is tough for the retail stocks.
Higher wages and also the impact of tariffs. I mean, if they have to pay higher prices because of tariffs, right, they will either pass that cost on to the consumer, right, or they will eat that cost. Right. Same thing with wages. They'll pass that on or they'll eat that cost. Two things to contend with.
So I think that what we're seeing, higher wages, right? Okay, so that's putting pressure on retailers who have labor as one of their line items in their income statement. But we haven't seen them yet see whether they have any pricing power. That hasn't started yet, particularly in restaurants. They've been hesitant to raise prices, but I think we're going to start seeing that. And I think that obviously adds to an inflationary sort of spiral upward. I'm not so afraid of a general trajectory of inflation upward. It's the frog in the boiling water kind of thing. I'm not so afraid of the Fed continuing to raise. If they raise next time and then they talk about 3 raises, I'm not so afraid of that.
As long as the frog is in the water as it is boiling, as opposed to tossing the frog in once the water has boiled.
Exactly.
It's 2 different scenarios.
Yes.
See,
animal lovers, please don't email us. We understand this is just a metaphor.
It's just like Guy and I to start the show with that metaphor. I would not have known how to play the game either. I don't know about the frog and the water. But what I do know is that Europe printed 4.2 on CPI. They have inflation around the world, and we're probably getting in here. The one thing about these trade tariffs, folks, is you haven't seen one iota of trade tariff in anything you buy yet. Okay, and it's all, you think about it, why is the market not responding? Because the market has not seen any data. So why is the XRT down almost 7.5% in the last 28 sessions or so? It's not just because we woke up and said, that there's going to be inflation. I also just think that this is rotation. It's the start of a new quarter. These things had run. You've seen this whole thing, momentum versus value. You've seen, whether people that are coming on our show or whether you're reading strategist reports, this is part of where people are going right now. So to say that the market is down and that XRT and restaurants are in trouble, suddenly, I'm not so sure.
Okay. At the same time, I mean, is this the reason to rotate out of consumer discretionary, out of retail, because of the whiffs of inflation that we are getting? To Tim's point, we haven't really seen the impact of the tariffs on anything that we buy yet, but it is coming, and we might in fact have tariffs on every single item that we bring in from China. So at that point, does that mean not only is retail an outperforming sector compared to broader markets, but is this another reason to sell?
I think so. In terms of retailers, yes. I mean, if you look, retailers for example, I mentioned Nordstrom's, I'll mention it again. You've had basically upper left to the lower right. The stock has been going down over the last 5 or 6 years. However, within that time frame, you've seen moves to the upside of significant proportion. And I think that's what we saw over the last couple of weeks or so. Now it's starting to give it back. I think they will continue to give these moves to the upside back until we get back into the earnings releases in 3 or so weeks. So I do think, yes, you sell the retailers
Let me just push back. So we have this wage increase now. Aren't these the people who receive the wage increases? Aren't they shoppers? Aren't they now? Don't they now have more disposable income to spend? So to me, I think we could be looking at a very strong holiday season. Going, so for the next 3 months, I think we could see very strong consumer discretionary spending.
Yeah, but isn't that what we're talking about? Is that you're going to see some slight wage inflation, but we're also seeing inflation. We're seeing the effect of tariffs. So they're going to counter each other out. And when you think about consumer confidence, it just printed at an 18-year high, right? That's kind of a backward-looking thing. When you look under the hood, you're seeing that large. We were talking about this last week. You're seeing large purchases being pushed out. We're seeing a housing market that's specifically challenged. We're seeing an auto market that is just, it looks like in shambles. When you look at those two groups of stocks, you say to yourself, my goodness, they're both at 52-week lows. Look at the underperformance in the bank stocks. They're supposed to get this growth in a rip-roaring economy from all this lending, but if housing and autos are constrained right now, where are they going to get it?
And part of that is higher interest rates causing the consumer to pay more in interest. And so you have a consumer whose wages are increasing, and that may offset the higher prices at the store, but does that also offset higher interest payments on their mortgages, on their credit cards, on their auto loans, on their student loans, et cetera?
I think that's as big of an issue as it's higher rates. I think the variable loans right out there for people that took 7-1 ARMs or have auto loans or have credit cards that still, not everybody's, rotating credit cards and playing that game. I mean, a lot of people are feeling this. Again, look at airlines, too. I mean, are airlines selling off because of oil prices? And is it another feed through? I just think that, yes, we have inflation. But these forces didn't just pop up yesterday. I think we've been talking about them for a long time. And I think the labor costs are very significant, and that's the most important thing that the Fed's going to look at. I think what we've seen in the last 2 days is some extreme rotation, and that is something that actually, I agree with Karen. I think the fourth quarter, this consumer is going to be alive and well in this holiday season on difficult comps, but they're not falling off the map.
So what do we want to be in? I mean, if you're concerned about retail,
I want to be in energy. And again, I think it's a function of these companies have been much more efficient on their capital allocation. They're being run for equity shareholders. I like the integrateds here. They're very cheap on a price to cash flow.
It's funny, we talk about consumer discretionary. You look at the XLY, that's the ETF that tracks it. Amazon's 24% of that ETF, and it's up 65% on the year. And it's got $1 trillion market cap. So when we look at the XLY, I don't think we're seeing the sort of outperformance that you think when you X out Amazon, and that is not a good sign for the rest of retail. And I would just say, I would look at more staples, and I would call that media. I would look at like the AT&T, and I would look at Disney, which looks like it's about to break out to new highs. And AT&T has been a huge laggard to Verizon, and I think as people get more clarity about the integration of Time Warner, I think they're going to like that story.
I think healthcare will continue to be a sector that outperforms and continues to catch up to the broader market. And I'll say this real quick. Don't underestimate the U.S. consumers' want to spend. The U.S. consumers, as long as they feel good about things, and to me, feeling good about things is the stock market goes up every day, people feel richer, whether they are or not, doesn't matter. They will spend money. But consumer debt to GDP now is north of 50%. So the consumer might be in great shape in terms of mentally, but the balance sheets don't suggest that they're in good shape as much as they would like to think they are.
So when I try to think about where do you want to be, what kind of asset allocation do you want to have in a rising rate environment? So real estate doesn't tend to do well. The market, if we really see it, won't do well. I mean, to me, something like Sotheby's, ticker BID, art, is an interesting place to allocate resources in an inflationary environment for the upper end.
What do we see today, then, in terms of the rise in utilities and staples, the things that have the dividend yields that shouldn't theoretically do well in a rising rate environment?
Well, I think people are still looking for yield proxy plays. But I was also just going to bring up, how about the move in gold? It's like gold woke up out of a slumber in the last couple of days, and that to me is remarkable because gold has had so many opportunities to pick their spots on all the other reasons.
Is that confirmation that inflation is here?
Yeah. I'm not going to say any couple-day move on gold means anything because I think gold has not followed through on those moves, but this is very interesting.